Hello, welcome to the second video. In this video, I'm going to read through the scenario regarding skincare formula, as well as the other section called disposal of a branch or something of that nature. And then I'll cover part B and part C. The reason why I'm doing both together is that there's a link between the two, so so it's just much easier to do it in one video. Okay, so I'm gonna jump straight into it and read the scenario, then read the required, and then go on to Excel to answer it. So it says, skincare formula. During the 2019 financial year, the management of Eco Beauty Ltd decided to embark on a research and development project to develop a completely 100% natural skincare formula. The research commenced on 1 March 2019, so that's the beginning of the current financial year. And on 31 March 2019, 1 month later, all the criteria for the recognition of the formula as an internally generated intangible asset were met. Development of the formula was completed on 31 December 2019. So remember, when we have an internally generated asset, so when we have research and development, there's two phases, the research phase and the development phase. Now, when something is in the research phase, then all costs needs to be expensed. But once it meets the development criteria, then, so once it's in the development phase and it meets the criteria to be capitalized as an intangible asset, then we will capitalize all expenditure as an asset. Okay, so that's very important. So remember, we must understand two parts. Number one, while it's in research, it will always be expensed. Once it goes into development, the question we need to ask ourselves, when it went into development phase, does it meet the criteria in terms of IAS 38 to capitalize development costs? If it don't meet the criteria, you will have to expense the development costs. But if it does meet the criteria, then we will capitalize the development costs as a cost of an asset. And what type of asset? An intangible asset. Okay, so just take note of that. So here they're saying on 31 March, when it went into development phase, all the criteria were met. So therefore, all costs from 31 March, basically all costs from 1 April will be capitalized. Okay, so just take note of that. What's very important, they like to use the beginning of the month together with the end of a month. So just make sure you get your dates straight. So for example, 1 March to 31 March is 1 month that it was in development phase. That it was in research phase. So basically from 31 March, which means from 1 April, effectively, we will start capitalizing all costs. Okay, so, and the thing was completed on 31 December 2019. Okay, Eco Beauty Ltd employed 4 scientists to work exclusively on the research and development project from 1 March 2019 until 30th June 2019. So if you count that, March, April, May, June, that's 4 months. Okay, of that 4 months, 1 month is research, 3 months is development. On 30th June 2019, one of the scientists was transferred to another project. From this date, meaning from 30th June or effectively 1 July, only 3 scientists work on the research and development of the new formula until 31 December 2019. So basically from 1 July up until 31 December, that is 6 months. Okay, so the whole project ran from 1 March until 31 December, which is 10 months. Out of the 10 months, 1 month was research and 9 months is development. So cost for 9 months will be capitalized from 1 April up until 31 December. A scientist earns a monthly salary of 48,000 Rand. Water and electricity costs amounting to 142,000 Rand directly attributable to the project were evenly incurred during the research and development of the skincare formula. So remember, from 1 March up until 31 December, we incurred 142,000. Of that 142,000, 1 month will have to be expensed because that is, it was in the research phase, and 9 out of the 10 months will be able to be capitalized to the cost of an asset because it was in the development phase, and the entire development phase met the criteria for recognition. The above-mentioned extraction machinery imported from the USA was exclusively used in the development of the skincare formula from 1 July 2019. After completion of the development of the skincare formula, the extraction machinery will be utilized in the manufacturing of the skincare products. Okay. The skincare formula was available for use as intended by management on 1 January 2020. On this date, it was estimated that the skincare formula has a residual value of 0 and a useful life of 7 years was allocated to it. Disposal group. On 30 August 2019, so that's during the current financial year, the management of Eco Beauty Ltd decided to sell the Cape Town branch as part of an initiative to generate capital funds for a future research project. On 30th November 2019, all the criteria to satisfy the branch as a disposal group held for sale, as stipulated in IFRS 5, non-current assets held for sale and discontinued operations were met. Management expects the sale to be completed for cash on 30th June 2020. Okay, so from here, you will be able to get, if they ask you for note disclosure, you'll get some information from here for your note disclosure. So remember, they made a decision on 30th August, but the criteria for IFRS 9 was only met on 30th November. So only on 30th November do we have to stop the initial classification of the assets of the disposal group and then transfer them to a non-current asset held for sale. Okay. Let's continue. The land and buildings of the Cape Town branch were originally acquired at a cost of 2,945. The land was 750 and the building was 2,195. On 1 May 2016, the building was available for use as intended by management on acquisition date, meaning from 1 May, that means from that date, we start depreciating. On acquisition date, a useful life of 30 years and a residual value of nil were allocated to the building. The useful life and the residual value of the building remained unchanged throughout the period. The carrying amount of the building on 1 March 2019, that is the beginning of the financial year, amounted to 1,987,694. The carrying amount of inventory of the Cape Town branch on 30th November 2019 and 29 February 2020 amounted to 465 and 428 respectively. The net realizable value of the inventory amounted to 450 on 30th November 2019 and 428 on 29 February 2020. On 30th November 2019, the fair value less cost to sell of the disposal group was determined to be 2,905 at the end of 29 February 2020. Let me read that again. On 30th November 2019, the fair value less cost to sell of the disposal group was determined to be 2,905. At year end on 29 February 2020, the fair value less cost to sell of the disposal group was the same as the carrying amount of the disposal group. Okay, so I'm going to stop there, and then I'm going to stop over there, and I'm going to switch over into Excel now. Okay, so you should be able to see Excel. I just want to go quickly and go read the required. Let's go look at the required. So additional information over here. You can see own occupied land, intangible assets, and machinery are accounted for on the cost model, and then it's written over on the straight line method of the estimated useful life. Okay. So in the first video, I did part A. I'm going to do part B and part C. Okay, so they say prepare all the general journal entries to correctly record the disposal group in the accounting records of Beauty Ltd only on initial classification as held for sale on 30th November 2019. Okay. Disclose the skincare formula and disposal group in the notes to the statement of financial position of Qb&Qc Ltd for the year ended 29 February according to the requirements of international financial reporting standards. So basically we must disclose the skincare formula, which is an intangible asset, and the disposal group we have to disclose. Okay, so we're going to do both in one in this video. So question B, we're going to deal with, what do I have to say now? We need to, so on 30th November, okay? So on 30th November, so let me do this here quickly. Okay, so on 30th November, we're going to process some journal entries. November 2019. Okay, so what is going to happen on this date? We're going to process journal entries relating to assets that can no longer be classified as PPE, and it needs to be classified now as non-current asset. Similarly, for the inventory. Okay, so on 30th November, what's going to happen? We're going to have to increase non-current assets held for sale. So we're going to have non-current assets held for sale, a disposal group. Okay, so you can use a proper terminology that they use. I'm just doing the journal entry. So we need to dispose. So we are going to debit. We're going to debit non-current assets held for sale. Okay, why? Because non-current assets is increasing. Non-current assets is an asset. So because non-current assets are increasing, non-current assets are is an asset, therefore assets are increasing. Assets increase on the debit side. Okay. What is decreasing? Inventory is decreasing. Inventory is an asset. Assets is decrease, and inventory is decreasing. Inventory is an asset. Assets decrease on the credit side. Okay, so we're gonna have credit. Okay, so if you have a look at this question, the asset inventory is for inventory on 30th November is 465. And the net realizable value on 30th November is 450. Okay, so what we should know for classification, we are simply going to use the net realizable value amount. Okay, so this will be 450. And the debit to the asset will be 450, but I'm going to do all of it together. What are we going to do? We're going to dispose of land. We're going to dispose of land. We're going to dispose of machinery. Okay. So with machinery, what are we going to be doing is the following. Okay. So for machinery, what we will be doing is the following. I'm going to do land first. Land cost is 750. So with machinery, there's cost and there's accumulated depreciation, right? So therefore, we must dispose of accumulated depreciation as well. Okay, so just take note of that. Okay, and all of them are SFP, just a transfer from one asset to another asset. Okay, so we're gonna have to work out what is so we have to work out what is accumulated depreciation. Okay, so under workings, I will have, so what do we need? We need accumulated depreciation. Okay, so first we know what is the cost price. We know what is cost. And we know what is carrying amount at 1 March 2019. Okay, so we know what that is. So the cost of the machine is 2195, and the carrying amount on 1 March is that amount over there. Okay, the cost was 2195,123. Okay, so therefore we can get accumulated depreciation at this date. Okay, so accumulated depreciation 1 March 2019. Okay, but now we don't want accumulated depreciation on 1 March 2019. We want accumulated depreciation at the date of reclassification, okay? Change in intention. So what we'll have to do, we'll need to work out what is depreciation from 1 March 19 to 30 November 19. Okay, so we're going to work out depreciation. Depreciation's costs, residual value, and that will give me depreciable amount. Okay, so this will give me depreciable amount. Depreciable amount. Then I'll have useful life, and that will give me annual depreciation. Annual depreciation. Okay, and then we want then I'm going to say number of months used in period, and then I will have depreciation for the period. Okay, so what is the period? 1 March to 30th November. Okay, depreciation for the period. Okay. Okay, so the cost is 2195,123. Residual value, what was it? Residual value of nothing and 30 years. Okay, so no residual value, and this is going to be that minus that. Useful life 30 years. Okay, so annual depreciation is that divided by 30. Okay, number of months used, so it is March, April, May, June, July, August, September, October, November. So it's 9 months. So therefore, we're going to say that divided by 12 times 9. Okay, so that is the depreciation for that period. So accumulated depreciation at 30th November. At 30th November 2019 would be the sum of these amounts. Okay, so therefore accumulated depreciation will be that. Cost will be 2195,123. So if I add up all of this, so the balancing figure will basically be disposal group. What's important to take note, this is before impairment. Technically speaking, you must apply impairment first. So what I suppose I would do, so what would happen after this, I'll show you in the next, what you call it. Maybe I'll just show you quickly over now. So there you can see that is the carrying amount of the disposal group, just as a side over here. So here you will have carrying amount disposal group. Then you would have fair value less cost to sell disposal group. Okay, so if you have a look at that, based on the calculation, we have that over there. Okay. And the disposal group, if we have a look at the scenario, they told us that the fair value less cost to sell on 30th November was 2905. Okay, 2905, 2905, 123. So here is an impairment. When is this impairment? When is this impairment? That minus that. So it's an impairment of 227. When is this impairment? On the date of change in intention. Because it's at the date of change of intention, the impairment will go against the underlying assets. Okay, so what are the underlying assets? Underlying assets, it is inventory, land, machinery. Okay, now impairment is IAS 36. Okay, so impairment that applies to non-current assets held for sale is IAS 36. IAS 36 do not apply to inventory. So the only assets IAS 36 applies to are these two. So that 227 will have to be allocated between land and machinery only. So what you must know, when there is an impairment at the date of change, the impairment goes against the original assets. For only after the date of change. So for example, at year end, if the non-current asset disposal group, if the fair value is different from 2905 at 29 February, then that impairment will go against non-current assets held for sale. Okay, so that's very, very important. So basically, what would happen is the following. We should actually decrease so I'm going to leave it at this, the journal entry that is required, but if they wanted the impairment journal entry, you'd have to impair it by a further 227819. Okay, so just take note of that. But anyway, that is part B. So this is the answer to part B. Okay, so now I'm going to go on to part C. So part C wants us to disclose, part C wants us to disclose the two notes, the disposal group note and intangible assets. Okay, so let's just have a look. So what we're going to do over here, what do they want? They ask us to disclose. So the first thing you have to do is state the company name. What is this company name? Eco Beauty Ltd. Eco Beauty Ltd. Company name. Then second thing, the name of the statement. It is notes to the annual financial statements. Okay, and then the date for the year ended. What is the year ended? 29 Feb 2020. Okay, so there's three things: company name, statement name, and date. Okay, so what do they want us to disclose? The skincare product. You can't write skincare product. There's no asset called skincare product. You need to put it in terms of one of the classifications of accounting. So is it PPE? Is it inventory? Is it in financial instruments and so forth? Okay, so what is it? It is an intangible asset. Okay, so it's an internally generated asset. It's an intangible asset. So we're going to have intangible assets. That's the note. And over here we will have disposal group. Okay, so the intangible asset is simply similar to that of similar to that of PPE. So we're going to have here internally generated asset. Okay, so you can call it that. We're gonna have costs, accumulated amortization. Okay, then we would have carrying amount 1 March 2019. Okay, then you have the movements during the year. Okay, so what it will be internally generated asset capitalized. So you can't call it additions. So addition like a purchases. So we won't call it that. We will call it based on what happened. We capitalize an internally generated asset. What else happened? There'd be amortization. Okay, there would be amortization. Okay, and then this would give us that over there. Okay, but this would be 28 Feb. Now we know this only happened in the current financial year. So it will be zero costs, will be zero amortization. So the carrying amount, at at the beginning of the year would be 0. Okay, let's make this. Okay, so it's going to equal that plus that. Okay, let me just do this. Okay, so now we need to work out what is the cost and what is amortization. So remember, we most likely won't call it amortization because it's not going through the income statement. What's important to take note, this asset is used in the production of inventory. Okay, so this asset is used in the production of inventory. So depreciation that is used in the production of inventory basically gets capitalized to the cost of the asset. Okay, so you might just take note of that. It basically gets capitalized to the cost of the asset, but we will leave it over there for now. It is okay to put it over there. Okay, so what am I going to do? I'm going to work out this number. Okay, so I'm going to work out this number. I'm going to put here workings. So remember what so what you must remember over here, that we will only capitalize anything that is a development that is in the development phase, but we can't just capitalize all development costs. Okay, which costs can we capitalize? Development costs that meets the criteria for capitalization. Now they told us development happened from 31 March 2019. And from 30th March 2019 or 31 March 2019, the criteria were met. So therefore, all development costs meets the criteria for capitalization. So all costs during the capitalization period will be capitalized. Okay, so just take note of that. So the first cost was so capitalization is met from 31 March 19 to 31 December 19. Okay, this is so March is done, so you count from April. So it's April, May, June, July, August, September, October, November, December. So it is 9 months. Okay, so just take note of that. So what can we capitalize? So let me go up. So what can we capitalize? The following. Where is this now? Okay, so here we say employed scientists to work exclusively on the project. So remember, 4 scientists were on from 1 March to 30th June. Okay, so 4 scientists were from 1 March to 30th June. But we can't count from 1 March. We must count from, so 4 scientists. Okay, 31 March 19 to 30 June 19. Okay, so we count from 31 March because the cost of March does not apply. Okay, but that was in the research phase. So we have 4 scientists. Okay, so it is 4 scientists multiplied by how many months? We don't count March, we count from April. So it's April, May, June. 3 months times a cost of 48,000 Rand. Okay, so it is equal to 4 scientists that were there for 3 months in the development phase multiplied by 48,000 Rand. Okay, then we had 3 scientists. Okay, and they were there from 30 June 19 right up until the end, 31 December 19. Okay, so that is going to be 3 scientists times 6 months, because we don't count June, which is the end of June, so we count from 1st July up until 31 December, which is 6 months, and the cost is still 48,000 Rand. So it's equal to 3 times 6 times 48. 1, 2, 3. Okay, then the last thing we will do is this over here, water and electricity. Water and electricity. Okay, so water and electricity. So it is 142. Okay, we added from what was all incurred in the research and development phase. So from 1 March until 31 December, that is 10 months. Okay, but how much of the 10 months was the development phase? 9. Okay, so so from 1 April was development phase basically. So we're going to say 142, 123 divided by 10 times 9. Okay, so there we go. The last thing we must do is that they tell us here the above extraction machine was exclusively used for the skincare from 1 July 2019. So therefore, from 1 July 2019, any depreciation we will include. Okay, so any depreciation we will include. So therefore, we will have depreciation will be capitalized to the asset. Okay, so 1 July 19 to 31 December 19. Okay, so the depreciation for this will be capitalized because it's used in the cost of an asset. We will capitalize that depreciation. So just take note of that. So let's have a look. What would happen over here? Let's work out the depreciation. Okay, so I'm going to use that formula used in over here. Use this formula. Okay, so I'm just going to go fetch that number. So remember from QA, the cost of the asset was that. Okay. Basically I can, so the cost of the asset was that, and the residual value was 55,000 Rand. Okay, so I'm just going to paste it over here. Doesn't it change this formula, make it positive as well, just for consistency. Just for consistency. Okay. So there we go. The useful life, I think, was 5 years. 5 years, yes. So the useful life here was 5 years. So annual depreciation is 31. Okay, but we only use it for 6 months. So I'm going to change it to 6. So there we go. The depreciation to be capitalized is 15. Okay, so the depreciation to capitalize. So from 1 July until 31 December, the asset was used. So depreciation will be incurred. But because the depreciation incurred is in the relates to making another asset. Okay. The accounting standard says you will capitalize the depreciation. Okay, so you won't expense, you will capitalize it. So just take note of that. So if I add this up, cost of asset, it will be that over here. Okay, I'm going to do something here quickly. This is here from QA. Okay, so there we go. What am I doing now? So the internally generated asset would basically equal that amount over there. Okay, so just take note of that. Then we must work out depreciation. So depreciation on this asset would be as follows. Useful life, and then you can actually just use the exact same thing over here. Okay, so I'll just put here working one. And this will be working two. Okay. Okay, so the depreciable amount is 0. This is 7. Okay, and the number of months used, 2 months, because it was ready for use on 1 1 Jan, so it's January and February, 2 months. Okay, so there we go. So amortization would simply be equal to that. Okay, this here is working one. So the cost of the asset is going to be that. The accumulated depreciation or amortization is going to be that. So there we go. So that is the cost of the asset. Okay, so you can put a note over here that the cost of the asset is that, and the remaining useful life is so the 7 years, we use 2 months. So the remaining useful life is 6 years and 10 months, and that's it. So I'm not going to put those wording in. You can put the wording in. Similarly over here, I'm not going to put the wording in the disposal group. You can put it in, but with the disposal group, you'll just add this wording. You can look at the solution, but basically they add information, this information over here. Okay, I think they exclude this part. I think you would exclude that sentence, but basically the first sentence and the second sentence. Okay, but you can look at the solution. So just check the solution. Then what you will realize that it's just this paragraph that you just copy and paste and put it into your answer. Okay, so you don't think about it. But what you need to do is put in the amount. Okay, so what you need to do is put in the amount. So what we have to do is put in the amount. Okay, so what is the amount that we have to include? So what's very important, we have to include the following. Okay, So if I go back to question 2, here you can see the non-current asset is 3.1 million. Okay. So if I use this thing I had here at the bottom, I'll actually take it across. Or let me just see if it's hard coded. If I take this calculation across, you will realize that based on question B, um, we have the disposal, the carrying amount of a disposal group of 3.1. But the fair value of the disposal group is lower than the carrying amount. So therefore, an impairment have to take place. This impairment will be allocated between the machine and the land. So this impairment will be allocated between the machine and the land. Okay, so just take note of that. This will be split between the machine and the land. You don't split it with the inventory because the inventory don't fall within the scope of IAS 36. So therefore, we would have a disposal, so the actual disposal group at 30th November. So the disposal group at 30 November is actually equal to 2905. Okay. Once we process that, once we get that number, we'll have to process an impairment loss of 227, which will bring us to the fair value. So a disposal group, same with a non-current asset held for sale, needs to be recognized at the lower of carrying amount and fair value less cost to sell. So that is carrying amount. So fair value less cost to sell is the 2905. So therefore, the disposal group is that. Now, what is the disposal group made up of? Okay, so the disposal group is made up of, how do we get to 2905? We would have gotten to it as follows. It would have been land, machinery, and inventory. Okay, it would be land, machinery, and inventory. Okay. At 30th November, inventory in the inventory balance was 465. The inventory balance at 30th November was 465, but the NRV was 450. Inventory must be recognized at the lower of cost and NRV. So NRV is lower, so this would be 450. Okay. Okay. Now for the land, what we should know is as follows. Okay, so the land is 750. The carrying, I'll just go fetch it from QB. Question B. Where was that? The land. Okay, I'll leave that. So the land is 750. Let me actually go fetch it. Equal land. Where is this now? Okay, so it is that. And then machinery is going to be cost minus accumulated depreciation. Okay, so that is basically what it is. Okay, maybe I'll just cut this out. This is land. So here we have asset. We have carrying amount before impairment. We have impairment. And we have carrying amount after impairment. Okay, so we don't include inventory over here, because inventory do not form part of IAS 36. Okay. Okay, the impairment is going to be as follows. Okay, so the impairment is going to be, that's the impairment amount multiplied by that divided by the total. So we basically do a weighted calculation. Similarly, it's going to be that multiplied by that divided by that. Okay, so it's a weighted calculation. So if I add up, you'll add up to the total impairment. Okay, so the carrying amount, that minus that. Okay, so if we put in a land would be that amount, and what you got to do would be that amount. Okay, working for. So if we add this up, you would see it will come to the 2905. Okay, so that's what we want. So that's important to take note. Okay, so that's important to take note. So that's basically how it looked at 31 November 2019. But we need to disclose, but what do we need to disclose? We need to disclose disposal group at, so we will have the disposal group at 29 Feb 2020. Okay, so we have to list the assets and the amount. Okay, so the assets is still land, machinery, and inventory. Okay, and that will give us the total. Disposal group. So non-current asset for sale, disposal group. Okay, just change this. What you'll notice, we can't apply depreciation or anything further because it's no longer land and machinery, so we use the amount as is. Okay, so we use the land, and so we will use land and machinery as is. So land will equal whatever we had over here. Okay. Machinery will also equal whatever we had over here. So working 3. What's important to take note, however, is what we use for inventory. So at 30th November, what did we use inventory? We used 450 because that is what inventory was. The NRV at 30th November was 450. What is the NRV at 29 February? It is 428. So now inventory needs to change to 428. So, oh, sorry, not there. That must be still be 450. But over here, 29 Feb, we need to use the lower of cost and NRV. So the disposal group at 29 February is 2883. So that will be the answer. Then you will add in this paragraph like I told you. We'll add in that first paragraph. You'll add in this first paragraph over here, and you will then also tell them, you will then also say over here, after you add in the first paragraph, you'll add in that paragraph over here. And then over here, we can just say, included in the disposal group, is a remeasurement loss of, what was it, amount? Cannot remember. Of 227819, of 227819 that was recognized on classification of the disposal group. Okay, so you'll just say that. And then you can say, if you want to, there were and then, yeah, so that you will basically say, okay, so that would be what you will tell them, that at initial recognition of the disposal group, there was a loss of 227. Then you will also include, so remember, what was that now, equal 450, 123 minus 428, 123. A further 22,000 remeasurement loss was recognized at year end. Okay, and that's basically it. So you include this, and you would include that note above of saying what it is, that you made a decision to sell and all of those type of stuff. You'll put it in over here. You'll have this note, and then you would have that line over there. But you can look at the solution, but those should be the numbers. Okay, so that's it from my side. That is part B as well as part C. So far we have covered part A, part B, part C. Okay.